Hi everyone, welcome back to this week's Technical Insights. Last week was a week full of economic data release. On the Singapore side, we saw our 2023 full-year GDP growth revised downward marginally to 1.1% according to data from the MTI. It moderated from the 2022 full-year growth figure of 3.8%, and the MTI kept its 2024 growth forecast range unchanged at 1 to 3%, noting that the external demand outlook has remained mostly unchanged since its last economic survey in November. We also heard from our DPM and Finance Minister Lawrence Wong on the 2024 budget, where Singapore pledges to support households and companies as cost rises with the tweaks to our CPF and personal income tax. On the US side, we have the latest reading on the CPI and the PPI data, both of which came in hotter than what economists had expected, lifting the US dollar and the US yield while the gold price had a pullback. So that may explain why the US market ended mostly in the red last week, as hope of a Fed rate cut in May subside further. Before we dive in deeper, let's do a recap of what happened last Friday on the global markets. Our STI index rose 1.42% last Friday in one of the best trading days this year, led by gains in Seatrium and Yangzijiang shipbuilding. Key indices in the region had a shorter trading week due to the extended Lunar New Year holidays. The Nikkei 225 index advanced 0.86%, while the Hong Kong Hang Seng index jumped 2.48% last Friday. On the US side, stocks slipped again last Friday after yet another hot inflation report from the PPI data that stoked fears that Federal Reserve rate cuts may not arrive until the later part of this year. The broad S&P 500 index fell 24 points or 0.48%. Dow Jones Industrial Average declined 145 points or down 0.37%. Tech-heavy Nasdaq Composite Index lost 130 points or down 0.82%. All three US indices clocking their first weekly loss of the year. For the week, all three major US indices broke their 5-week winning streak to end the week in the negative. The Dow Jones Industrial Average ended the week lower by 0.11% to close at 38,627 points. The S&P 500 index also ended lower, slipping 0.42% to 5,005 points, just above the 5,000 psychological handle. The Nasdaq Composite Index tumbled 1.34% last week to settle at 15,775 points. The Producer Price Index for January, a measure of wholesale inflation, increased by 0.3%. Economists polled by Dow Jones had anticipated a gain of only 0.1%. Excluding food and energy, core PPI rose by 0.5%, higher than the expected of a 0.1% advance. As a result, 10-year Treasury yield spiked above 4.3% following the hot PPI reading, the highest reading we see so far this year. In Asia, Hong Kong markets had a shorter trading week due to the extended Lunar New Year holidays. Trading resumed on Wednesday, 14th of February. In the 3 days trading week, the Hong Kong Hang Seng Index managed to close their second consecutive winning week, up 3.77% to finish at 16,339 points. Hong Kong Hang Seng Tech Index also jumped 6.89% in that 3 days to finish at 3,342 points. Our STI index also got a break last Monday and resumed trading on Tuesday, and for the week, we are up 2.67% to 3,221 points, the best trading week that we have so far this year. Breaking down the performance of the STI index, DBS continued their march upwards after they announced their record earnings 2 weeks back. In the previous video, we identified the support for DBS share price at the 50 days moving average at $32.07. DBS Bank share price hit this support level last Wednesday and rebounded 4.09% to close at $33.87 above the first resistance that we identified at January high of $33.64. So this is a formation of a higher high, which could signal the start of a sustainable uptrend. For UOB, the bank also joined in the rally, rising 3.73% last week to finish at $29.19. OCBC Bank would not want to be left out of the party either, and they rise up 2.39% to settle at $13.26. SGX also rebounded last week, up 2.29% to $9.37. Top gainer last week on the STI index include SIA, which was up 7.65% for the week to $7.32. Seatrium also rebounded up 6.9% to 9.3 cents after a 13% decline the week before, which we also covered in the previous video. So for this week's technical analysis, let's look at both SIA as well as do a follow-up on Seatrium. First, let's take a look at SIA. Last Friday, SIA share price rose 1.24% or 9 cents to $7.32. For the week, the stock was up 7.65%. Looking at the price chart of SIA, the share hit a high of $7.67 last year in June before sliding down to a low of $5.77 in October. After touching the low in October, share price rebounded to $6.60 in December and have been range-bound until the end of January this year, when Singapore and China reached an agreement on a mutual 30 days visa-free entry arrangement that begins on February the 9th. Last Thursday, SIA announced that they recorded a year-on-year 14.4% rise in group passenger traffic to 12.6 billion for January of 2024. The group, including Scoot, carried a combined 3.2 million passengers in January 2024, rising 23.1% from the 2.6 million in January 2023. Group cargo load also soared 19.7% to 469 million ton-kilometer compared to the 391 million ton-kilometer the year before. As a result, some brokers upgraded SIA to buy calls with their third quarter results update due on February 20th. So is it still a buy after the 7.65% rise last week? According to the MACD indicator, the positive reading shows that there's positive momentum in the share price right now. The MACD line is also diverging away from the signal line upwards, indicating that the upward momentum may accelerate further. The RSI indicator, however, has breached the 70-point overbought level. The latest reading now is at 85, above the 14 days moving average of the RSI at 73. During the peak that we saw in June last year, SIA RSI hit a high of 92. So the current reading of 85 may still have some room to run before a pullback happens. The next resistance for SIA share price will be the June high that we saw last year at $7.67. Next, let's do a follow-up on Seatrium. Last Friday, Seatrium share price rebounded 8.14% or 0.7 cents to 9.3 cents, and for the whole week, the stock is up about 6.9%. The week before, Seatrium fell a total of 13%, so last week bounce erased more than half of those losses that we saw the week before. Both the MACD indicator and the RSI indicator were negative in our previous analysis, and the next support level identified was the 7.8 cents low that we saw in 2021. Fast forward to last Friday, the MACD indicator has shown signs of convergence towards the signal line. Through the whole of last week, we also saw the subsiding of the negative momentum from the MACD histogram as well, but the MACD reading is still negative, so the downside momentum is still present in Seatrium share price now. The RSI indicator also rebounded to 39 points last Friday from the low of 21 points the week before. The 14 days RSI moving average is now at 30. Both are below the 50-point neutral mark, so the momentum in Seatrium share price is still very weak. From the bounce last Friday, we are now closer to the 20 days moving average at 9.8 cents. This is the first resistance to look out for should Seatrium share price resume its long-term downtrend since July of last year. So we would like to reiterate that the next support level that we are looking at for Seatrium is the 7.8 cents low that we saw in 2021. And the 20 days moving average that you see over here at 9.8 cents could be the first resistance level to watch out for should Seatrium resume its long-term downtrend from July last year, with the earnings result coming in later this month on the week of 26 February. And that's all I have to share for this week's update. Thank you for tuning in, and do give us your support by giving us a like or a share and hit that subscribe button to stay up to date to our latest content. And I'll see you again next week in the next Technical Insights.